Hello guys, this should be one of the shortest videos on this course. And I'm going very straight to the point because I don't want to waste time. I just want us to grab what we want to grab and go back and practice. Okay? Trading is not easy if you can learn patience and just know what you are doing. All right? So higher time frame analysis. What I'm going to show you in higher time frame analysis basically is how we analyze from monthly to weekly to daily. That's all I'm going to be doing. Okay? And the basic things to look at. Now, these are the three major things you have to notice. The EMA 250, Fib levels, and liquidity. Well, liquidity might not be everything now. Might not be what we might really talk about here. But you see, EMA 250 and Fib levels, they are important kind of for smaller time frame analysis, especially when you already know liquidity. So let's talk about, let's go to the weekly time frame. This is where I like charting my course from. Mostly the weekly time frame. Now, if you are looking at the weekly time frame, what is the directional bias? This is the first thing I look at in the market. First things first, directional bias is ranging. Price is literally ranging across this place, right? Price is literally what? Ranging. But before the range, we had a bearish move, right? We had a bearish move. Now, if I am to open, let me remove this guy. If I am to open EMA 200 and EMA 50. EMA 200 and EMA 50. Okay, this is not my premium account. Sorry, guys. This is currently, let me set to the setting. So we have length 200. This is EMA now. Okay, so let's just put it at this style. Let's just put it at a ticker button. A ticker button. Let's make it red. Okay, so let's mark that. Now, EMA 200, if you look at how EMA 200 works on this, you see that price most of the time taps into 200 and just bounces. Because it's the bigger time frame, it respects it a lot. You can see how it broke. It came to retest it here and fell. We tested it here and fell. We tested it here and fell. We tested it here and fell. You know, and since it has been ranging, it has just been ranging in between the lines, right? But once price is moving in a direction, it respects 200 EMA or 50 EMA a lot, right? And that is that about that basically. But then there is something about the Fib levels for the weekly time frame. I will just show you quickly. We have been on a downtrend, right? From a very long time. But there was a Fib level at some point. What did Fibonacci do? We had our lower lows, lower highs. It broke this low, lower lows, lower highs. And where was our next break? This was the high that took out this low, right? So this is our next high. So let us draw our Fibonacci from here to here, from the top to the bottom. From the top, from here to here and calculate it up to this point, right? From here to the lows here, right? And I want to show you something important. On the weekly time frame, the weekly time frame traders, when they trade the Fibonacci, they actually take their profit on minus 27 of the Fib level, okay? I'm going to open the Fibonacci now. You take a screenshot of the setting, okay? Take a screenshot of the setting in 5, 4, 3, 2, and 1. Okay, good. They take their profits at the minus 27. So if I catch this move and it pulls back to my minus my 78.6 level, which it didn't get to, but it got to our 61.8. Some people take their trade off 61.8, put their stop loss above the 100 level, just right on the 100 level. Your target should be the minus 27. Let me put that there. So you take your trade from here. Your stop loss would be here, and your TP would be has to be on minus 27. Because on the weekly time frame, they respect minus 27 as TP a lot. Okay, I will show you that on gold as well. There was a trade I played long, I caught on gold with this type of behavior, okay? And you can use it to potentially know where price is going to reach, right? That no matter what, price is going to get there, right? This is higher time frame analysis for me. Especially if you want to look at what to trade on the higher time frame. This is important because you might be a busy person. Just take the analysis, walk away. When price gets there, it picks your trade, walk away. You can walk away for 2 months. It will just keep moving in your direction. Okay? Especially if you use other confluences with it, like support, resistance, and all of that, which is not what I will dive into here. Meanwhile, after this range, we have had a break right here, right? So in the past few days, or in the past few weeks, rather, in the past few weeks, you can see that price pulled up here and broke structure, pulled up here and broke structure. So that means, let us see how the Fibonacci played out here. So from this highs to this low, we can see the nice pullback there. So let's draw our Fibonacci. That I think that's 50% or 61.8% to this low right here. You can see that price came and almost tapped into 78.6% right there. Now, if you took your trade off the 61.8, your stop loss would be above the 100%. And where will your TPB? Minus 27. As you can see, price almost got there and bounced off. Let me see. I think this they took this offline. Let me put the line chart. Let me see if it was line chart that they used to get this thing. They drew this ship with line charts. They drew this ship with line charts. Very sneaky people. So the trade was triggered directly on 61.8 according to the line chart. According to the line chart. And our minus 27 was smashed with body. You can see minus 27 was smashed with body. The body closed on minus 27. You can see what I'm talking about to the weekly time frame. And it was a very smooth one ratio, 2.17 there. Very, very smooth. So these things work very, very well with the bigger time frame analysis. Okay. Sometimes you can break this down to the daily time frame to take a trade. Meanwhile, I can see a very nice liquidity trade here where we have our break above, price breaks below, pulls up. You know, this is our change of character. Remember, change of character, price pulls up, breaks below now becomes our new liquidity. Price now comes to the extreme, towards the extreme. At least our entry will be on the liquidity right there, taps into here and then sells, right? So your entry in this type of scenario will be on the liquidity, basically to be on liquidity right here. And your stop loss will be right above the highs. And your TP, if you have your FIB or whatever, your TP should just be this low. But if you have other reasons to extend your FIB, why not extend your TP, right? And that is what we had here. Let me draw it for you guys. Let me draw it for you. So we had these lows and then the sweep. As you can see, price pulled back, gave us liquidity, sold, then swept that liquidity to pull up. That is what we have here. And then sold finally to the extreme lows. You can see the pattern as it formed right there. Very, very neat pattern. So your entry would have been here on the liquidity, and your stop loss above the highs. And then your TP, if you used FIB as extra confluence, your TP will be here, 1:1.8 or the minus 27 right there. So this would have also been a very sweet trade for us to take using either liquidity or Fibonacci levels. But one thing I want you to know is that minus 27 is a very important TP taking tool for big time frame traders. It's a secret that a lot of people don't know. Let me show you the trade I took on gold that I bought. Oh, yes, you can see that I still have my label in there. You can see I still have my label in there. You can see right there, I still have my label in. Minus H4 minus 27 TP. You see how price came right into it and took it. Weekly minus 27 TP. Look at how price came into the weekly minus 27 TP. You can see how I marked it. Now, how did I know that TP? How did I know that was going to be TP? That's the question a lot of people were asking. How did you know, sir? How did you know that was going to be TP? Let us look at the eyes first of all. There's a TP. I think there's a TP above. No, that TP, I think I removed it. That TP is 20. Let me show you. this low to this low here, because price is on an uptrend, right? So if we draw a Fibonacci from this low right here to this highs right here, this highs right here, price has pulled back and almost tapped into our minus 78. So let's change this to line chart and see what we are actually doing. So if we put it here and our 100% here, as you can see, let's go back to candles. You can see that price tapped directly, rejected 3 times on our minus 78. Where is this TP going to be? This thing is disturbing me. Where is TP going to be? Exactly, just like you said, minus 27. Now, look at that last spike on price. Look at this last spike on price. See this last spike on price. You can see that that last spike attempted to tap into the TP zone, weekly TP level, but it did not tap into it. We might see some sales, then price will go and smash that TP level before it now comes back to now sell very, very well if it wants to sell, right? So you have to always see this as a cheat code to yourself. Now, what this thing will give you is, imagine price was still here and it has never even come close to this place. One thing I will know within myself is I can still keep looking for buys on gold till price gets to minus 27. That is when I will rest on gold. Until then, I won't rest. I'll keep buying. I will catch some sales though, but I will keep buying. I will keep buying until I hit that minus 27, because it's a weekly move. Do you get it, guys? It's a weekly move. And you don't want to Jones it, really. You really don't want to Jones it, as it is a what? A weekly move, as it's a weekly move. All right. So, guys, that is it about higher time frame analysis. And I won't really dwell much on that. For the EMAs, we have what we call death cross. This one, I won't talk about it at all, but I like to go and do your research. Death cross and golden cross. I'll give you an insight to it. When you have EMA 200 and EMA 50 on your chart, when EMA 50 crosses the EMA on 200 above on the daily time frame most of the time, that is a golden cross. And when it crosses it below and crosses it and turns to the downside, to the bearish side, that's the dead cross. Price is going to dump hard from there. And if it crosses to the upside, price is going to rise very, very hard from there. I don't want to show you that much here because just go and do your research on this as an assignment. But I don't use it to trade. I don't use it to trade at all. And I don't want to show you because it's not a strategy that works. But these are ideas that you can also use to get more insight when you research it. I don't use it at all. That's what I'm going to show you. I will only show you what I use. All right. So let us get into the next video where I'll show you how lower time frame operates using liquidity. So I'll see you in the next video, guys. Cheers.